Stefano, thank you very much for this. Froth is kind of a bad word, just like bubble is kind of a bad word, at least when it comes to people investing in the market. What exactly are you seeing, besides what I just reeled off, that makes you feel as though the froth may be something to watch out for?
Yeah, hi, Dom. Thanks for having me in the show. So, yeah, as you point out, there are different emerging signs of froth. One is ARK, which posted the second best rally in its history over the past couple of months. We have seen a comeback of SPACs, but more importantly, we have seen a very strong comeback from retail investors. So after Liberation Day, we do estimate that retail essentially poured 34 billions into US equities. And more importantly, their presence in the option markets is back, and it's strong. So, for example, Barclays developed this indicator called the Euphoria indicator, and we try to track across more than 1,000 stocks and their option markets, and we try to see stuff, like demand for upside and pricing of options, and try to identify cases in which there is max euphoria. And that indicator is now at levels that are comparable to the meme stock frenzy and the dot-com era. So to us, that's a strong sign that retail investors are trying to just chase the upside, and that kind of it's a warning sign to us.
All right, that's a fairly significant warning sign if you are comparing it to not just the meme stock craze, but the dot-com frenzy as well. If I were to ask you, what exactly in the market, what specific parts of the market you are seeing besides the ARK Innovation Fund? Are there places, is it artificial intelligence, is it tech in general? What exactly then makes you feel as though this could be possibly a redux of .com?
Yeah, just to be super clear, we're not saying that we're going to see a repeat of .com era. There are big differences. In particular, valuations are much, much lower. We're not really predicting what happened during then, but we're just saying that in terms of sentiment, it feels very euphoric. Now, to be fair, compared to, for example, the .com era, I think it's a lot more limited to certain corners of the markets, in particular crypto, some more AI growth stories. And, arguably, we're in a much better place in terms of valuation, again, compared to .com era. But compared to that, we now have a lot more retail investors' presence, and in particular in the option markets. And, some of these products, like, for example, levered ETPs on single stock, names like NVIDIA, Tesla, MicroStrategy, they've really taken off over the past year. That's an innovation. That's something that we didn't have during the .com era. These products are very, very popular with retail investors, and they tend to, offer a lot of leverage. That's really why they exist. Essentially, they offer leverage to retail investors. And if things go bad, obviously, that means that on the downside, you can see a very convex move.
All right. And Stefano, before we let you go, given that context, are there still opportunities for traders to take advantage of this euphoric type environment, either on the long side or even perhaps on the short side?
Yeah, look, trading bubbles is very hard. They are notoriously hard to time. And you can get burned if you're trying to sort of bet against. So our point of view is that in this environment, it does help a lot to try to navigate markets with options. And for example, again, we do have the Euphoria indicator. We identify stocks that right now feel very hot. And, you can use options to either try to ride the wave, and while, you limit your downside risk if things happen. And at the same time, you can buy put options on those stocks if you think, you're just about to see the bubble burst.